Good morning, everyone, and welcome to today's webinar hosted by DavisGrant. My name's Nick. I'm the Marketing and Business Development Officer at DavisGrant. Today's topic is unclaimed tax, so a topic that I know will be interesting to a lot of you. And some Zoom housekeeping first. So if you're familiar with Zoom, you've probably been using it a lot during lockdown, but if in case this isn't, and this webinar works slightly differently to normal Zoom meetings, there is a chat function. You can chat amongst yourselves if you wish to, but the best way to submit questions is through the Q&A tab. So if you click that, and there will be time at the end of the webinar for some simple questions on the content of the slides which are going to be presented. So if you do have any questions that come up, or you think you need clarification on anything, please do click that Q&A button and select your and submit your question, and we'll get through as many as we can on the call at the end of the webinar. So welcome. Let me introduce your presenters today. You've got two of our top team, two of our directors. You've got Stephen Sandford and Ben Chernoff, both are directors here at DavisGrant. So they service a wide range of business owners and individuals such as yourselves. And between them, they have decades of experience to share with you today. So without much further ado, I'll hand over to Stephen, who's going to start off telling you about where there's some areas you could be saving tax, or in some cases even getting money from the government.
Thanks, Nick. And yes, good morning, everyone, wherever you are in the country, whether you're in a tier 1, tier 2, tier 3 location. I hope everyone is well and safe. And yes, you know, it's that time where we're focused obviously on COVID, but there's nevertheless, you know, we're all having business. We all got our businesses. We all have our own personal taxes that we need to pay, and it's a good time, a good reminder as we get towards the end of the year. We're approaching, you know, soon the back end of this tax year end, just to give perhaps some things are very obvious to some of you, some may not be obvious, just to give to you some ideas of some allowances, tax allowances that are around for you, and especially those that are annual allowances, so that if you don't use them in a year, you know, they're used up. So we will crack on, and yep, as you can see here, some of the key allowances that you can have. So as hopefully a number of you will know, each year you get a personal allowance of £12,500. So that's £12,500, where however it's made, employment income or whatever it may be, per person. And I'll come on to an example where actually using that, especially if it's in a husband and wife situation, you know, it may well be beneficial, and you may not have thought about utilising the full personal allowance of both husbands and wife. The second thing is dividend allowance. So for those of you old enough or can remember a number of years ago, dividends used to be incredibly generous and an incredible way to draw out money, profits from companies. Unfortunately, this has been reduced over a number of years. Nevertheless, at the moment, there's still a £2,000 dividend tax allowance for each person, each individual. And so again, coming up to a tax year, it's important, especially if you do own a company and you're able to take out dividends, that at a very minimum, you take out £2,000, assuming there's suitable distributable reserves in the company. The next couple is in connection with savings. So everyone gets what's called a savings allowance. So a few years ago, banks stopped deducting interest, and you get your interest paid gross to you. But you see there that for basic rate taxpayers, if you receive up to £1,000 in interest, there's no tax to pay. For higher rate taxpayers, there's no tax to pay if you receive up to £500 of bank interest. And then there's this little odd thing called the savings band. It's a bit peculiar, really a strange allowance, but essentially this was used for predominantly, I'm not being stereotypical, perhaps retirees, people like that, where they've had a significant amount of savings income, well, they would have done when the interest rates were half decent, not so now, but nevertheless, you've got savings income and you haven't got a significant amount of employment income. So there's a note there at the bottom, but essentially it means that if in that scenario, essentially you could have up to £5,000 of interest that you receive and no tax, but that's on condition that, as it says there, that your non-savings income does not exceed the sum of the personal allowance and the savings band. So just a little nugget there, but say probably affect more people who are retired. So we've got dividend tax, which again I've just mentioned, and so what I've done is put together a table combining some of those allowances, just to show you really, and appreciate this is perhaps a little strange, but nevertheless it shows you that the bottom line is that a husband and a wife potentially can have a joint income of £41,000 in a year and not pay a single penny of tax. And in this scenario, the husband and the wife both take a salary of £9,500, which is below the personal allowance of £12,500. Because of that, they can get this savings band, which I mentioned on the previous slide. In this case, they've got 6,000. They then top it up with some dividends as well. So there's a £2,000 dividend allowance, but because they're only £9,500 salary, the next dividends are still not taxed, are covered by the personal allowance. And so you can see there, as it follows through, that they have income of £20,500 each. By the time you then knock off the personal allowance of each of them, that leaves potentially tax to pay at £8,000, but per below, you can see that effectively the savings rate, the 5,000 savings band, is no tax. There's then the personal savings allowance as well, which was, as a basic rate taxpayer, as put on the previous slide, £1,000 no tax, and then the dividend allowance, £2,000, also no tax. So quite interesting. Again, where it's an owner managed business, and perhaps not making a huge amount of money, nevertheless, a husband and a wife can take out £41,000. So on to the next slide. I don't know if there's Nick, I don't know if you saw that chat. Apparently someone's not seeing the slides. So don't know if you
I've seen that. I think it's probably if the person's viewing on mobile, if you try swiping, please, anyone else who's having problems seeing the slides, please do let us know, but hopefully it's an isolated incident.
Great, thanks Nick. Right, so that was in terms of allowances and income. Another very important tax, hopefully is not too in the forefront of people's minds at this moment with COVID, although of course I'm having more and more people talk to me about this. It's amazing how many people are talking to me about life insurance cover, relevant life cover for businesses and things like that. So clearly, sadly, this is perhaps in people's minds more prominently at the moment. Nevertheless, so inheritance tax. Look, the big if you like, the headline figures are that each individual gets £325,000 in inheritance allowance, and in addition, an individual can also get a resident nil rate band of £175,000. And if one remembers a few years ago, essentially the reason why these figures came up is that the Conservative government wanted to have this figure that they picked, which was effectively, if parents want to pass on the property, the home property they were living in, down to the children, they had this figure of £1 million that would not be taxed. So each parent gets £325,000. You can combine it for spouses, add in £175,000 for each of them, and that's how you get your £1 million. Now, that's probably well known, I'd imagine, to most of you on this webinar. But just, I think perhaps on the right-hand side of the slide is what is perhaps slightly less well known. So it's just worth going over those. So you can give £3,000 a year out of your estate that will not be clawed back at all for inheritance tax. So up to £3,000, you can give that away, and should you die within 7 years, that's not reclaimed or recalculated as part of your estate. You can also give gifts up to £250 to individuals, again, not included as part of your estate. For marriage, there seems to be, quite generous here. So parents can give their children £5,000 on a marriage, and that won't be part of your estate. Grandparents, only £2,500. And if you're a guest of the wedding, you can give £1,000 to that, which is, again, very, very nice. And that also, should you die, one dies within 7 years, that won't be clawed back as part of your estate. Perhaps all of it, and the least well known of all of that is point 4, which is actually a very interesting inheritance tax planning strategy, which is what's called giving gifts out of regular gifts out of income. So it may well be that there are perhaps people on this webinar, or people that you know, or family, parents, or yourselves, where you'll still very much say you're working very hard, but you're still in your 60s or your 70s, and so thinking of legacy, that sort of thing, is perhaps more prevalent, more on your mind. But nevertheless, you're still working. You've got your business, you've still got income, maybe properties, whatever, rental income, whatever it may be. And so if you were to give a regular gift out of income, for example, each quarter you set a certain amount of money to give to your children that was fixed, that was coming not from your estate, from your assets that you've got, but from income that you are generating at that time, those gifts are excluded from inheritance tax. And it's a very, very interesting way to pass wealth down to children if you are still working, say, in your 60s, 70s, and fortunate enough to be in a position where you don't need all of that income, and so you could start to think about passing that down to children. Of course, last point, one can also give gifts to charity, which effectively the tax that you give on that uplifts the inheritance tax bands. So it's a way to encourage in your will leaving money for certain charities of your choice. So last point I just wanted to touch on before I pass on to Ben, just to talk about the next section, is just, again, capital gains tax. So if you're selling capital gains tax, selling shares, selling property, whatever it may be, just a reminder again that every year you have an allowance of £12,300. For basic rate taxpayers, that's tax at 10% and higher rate at 20%. And I have got clients that have for example, a sizable share portfolio in public companies, and they will they will sell a proportion of their shares each year just to get it, just so that the gain is just under whatever the exemption is, and they'll just chip away at it, and effectively it just gives a nice free amount of income each year. Just as a put there, I mean, the rules have now been in for some while, but just as a point that for properties, of course, selling properties, rather than at 10% and 20%, the rates are at 18% and 28%. So just worth noting those. Okay, so I'll pass over to my fellow director, Ben Chernoff, who's going to speak to you on research and development tax credits.
Thanks, Stephen. So research and development tax credits, these got very big in the last 5 to 10 years. Us at DavisGrant have been preparing claims for way over 10 years before they really got their name, and a lot of companies are now looking at R&D, and it's a good way to effectively claim either a tax reduction or actual physical cash back from HMRC. It is quite technical, so I'm not going to go into all the nitty gritty, but I'm just going to give an overview, and so you hopefully will have a basic understanding. And if you did want to kind of take it further and find out more, obviously please get in contact with us at DavisGrant. So just a basic background, it was introduced in April 2000, so 20 years ago now. Large company relief was introduced 2002. Over the last 10 years, the rules have changed significantly for the better in the last few years. But there was at one point around 7-8 years ago where the total claim was restricted to your total PAYE and national insurance bill. And this limited a lot of businesses who have either 1 or 2 employees or a very small payroll, but outsource a lot of their development work and use contractors and development companies. And because they didn't have many people on their payroll, they therefore were restricted on their R&D claim. Like I said, this was removed a while ago. The government have plans at the moment to bring this back in from April 21, but instead of being restricted to your PAYE national insurance bill, it will be restricted to 3 times your PAYE national insurance bill. There's been quite a lot of uproar throughout the R&D kind of industry because a lot of companies do outsource a lot of their development work. So it's still in consultation, and this might change before April 21. The fundamental principles are if you're a qualifying company, what the qualifying activities are, and if the expenditure is also qualifying. And I'm going to touch on these 3 points over the next few slides. So the technical criteria, what is R&D? So effectively, it's an advance in science or technology. So for tax purposes, it takes place when a project seeks to achieve an advance in science or technology through resolution of specific or technical uncertainty. So effectively, what we're saying is, has the business tried to achieve something that is not out there at the moment, is an advance in either science or technology. It also includes creating a new process, product or services. So if that also includes making improvements on existing products or services and using science and technology to improve these in a certain way. So not just, okay, I'm selling this certain service, but how have you used science and technology to improve that service and make it hard for a competitor to do. The pure product development in itself does not qualify. So like I said, just developing a product to sell on the shelf does not qualify for R&D, but it's effectively the science and technology and the development to effectively meet an uncertainty in the process that allows it to claim R&D on the cost. So what costs qualify? So the kind of these are the 4 main costs. So staffing cost, employees. So that includes the salaries, the employer's national insurance, and the employer's pension contributions. So again, if you've got an employee who kind of works fully on product development or is a developer, then you could claim anywhere between say 0 and say 95% of their time as R&D, depending what other work they do. Subcontractor costs. So again, if you are using a third party to do the development work, you can claim those costs. However, because they're using a third party and you're not using your internal employees, these costs are restricted to 65% of the cost. So if you spend £100,000 on a subcontractor, the maximum of that 100,000 you can claim is 65% of it. And again, later on, I'll go through the calculations and how that actually works. Software directly used in the R&D. So not just general software costs, they're not allowable, but if it's software you need specifically to develop your product or develop your your system or software, then that is allowable for the claim. And any consumable items, so things like raw materials, light and heat, power, used just for the development work, so whether that's testing or actual doing code writing, for example, that is all allowable, but rent is not included. You can't claim for the rent. So the majority of the people on the webinar, I'm assuming, have small, medium-sized companies. So I'm going to talk more in detail on the SME relief scheme. There is a separate scheme for large entities, which is not as beneficial. But if anyone has any questions on that, like I said, please do get in contact with us. So the SME relief scheme, so for profit-making companies, you effectively get 43.7% on tax relief on the qualifying expenditure. So how it works is you get an uplift for the expenses, and then you get tax relief on the uplift. So if you're getting tax relief, so if you're a profit-making company and you're spending £100,000 on R&D, you'll get effectively 43.7% of that amount you spend off of your tax bill. If you're a loss-making company, you can surrender the loss to get an actual cash refund from HMRC at 14.5%. So because if you're a profit-making company, you're getting the tax relief at 19%, effectively, for a loss-making company, the tax relief is only around a third, so 33.3% roughly, of the costs that you're spending. But because you're loss-making and it's not a tax reducer, you actually get physical cash back from HMRC. Grants and subsidies. So over the last kind of 6 to 9 months with all the COVID grants, a lot of our clients who've claimed R&D claims in the past have asked us how it's going to interact with R&D, and you really do have to be careful here because it's a state aid, and you cannot claim 2 state aids on the same project. So if you're receiving a grant, which is state aid for a project, you can then not claim R&D on that project. If some grants are not state aid, and therefore if you're not using the grant on that specific project, on those costs, you can still claim R&D on that element. At the moment, regarding the CBILS and other COVID funding, we're still waiting for clarification, but I'm sure as soon as we receive that, we will let our clients know. So financial criteria, what size business do you have to be able to claim R&D? So like I said, I'm going to focus on the SME size. So for an SME size business, you have 500 or less employees and either a turnover of less than 100 million euros and a balance sheet of less than 86 million euros. Because this is state aid based on Europe, currently the figures are in euros. I'm sure from next year this will be converted and there'll be a new sterling amount. But if you're part of a group and you're owned by a parent company more than 25%, you have to take into account all of the group figures. So if as part of the group, your turnover or balance sheet are over these amounts, you could potentially fall for the SME claim, and therefore you would have to do a large company R&D claim, an RDET claim. And again, the rates are quite a lot lower than the SME claim. We have done some of these claims, so again, please do get in contact with us if you need any help. So how is the R&D claim calculated? Like I said, it is quite technical, so I'm just going to go through a brief calculation. So this is one where they're profit making and therefore they're going to get a reduction of their corporation tax. So they're an SME, they've got taxable profits of 400,000. Included within this is 60,000 of qualifying R&D expenditure. So if they were claiming or if they were not claiming R&D, they would have a corporation tax liability of 19% on 400,000, so 76,000. If they were claiming R&D on the 60,000 cost, effectively you get an uplift of 130% on your expenditure. So I mentioned before the 230%. So that is effectively your cost that you spent. So your 60,000 plus the 130% uplift. So effectively your 130% uplift on your 60,000 is 78,000. So you get a further reduction of 78,000 off of your profits. So 322,000 at 19% is a corporation tax liability of 61,180, and therefore a total saving of just under 15,000. For a loss-making company where they're claiming actual cash back from HMRC, the calculations are slightly different. So a taxable loss of 200,000, again, they've claimed 60,000, they've got 60,000 of qualifying R&D expenditure. Normally, without a claim, they would just carry forward the 200,000. So potentially, if you think you're going to make profits in the next year or two, you might decide, if you're not that desperate for cash, that we're actually better off carrying forward the losses, because we're then going to get the benefit at 19% instead of at 14.5%. So without the claim, you would carry forward 200,000 to effectively get a benefit of 38,000. With the R&D enhanced expenditure, so we're getting again 130,000 on the 130% on the 60,000, so 78,000. Your losses increased to 287,000. And then what happens, you surrender an element of the loss. So again, it's quite technical. So again, if you've got any questions, please do get in contact. But the maximum you can claim is your 230%, which is your initial cost plus the uplift. So you effectively get 14.5% on that 138,000, and you get a tax credit of 20,000. And therefore you carry forward the future the unused losses to future years. So you're then going to get a carried forward element of 26,000. Like I said before, if you are thinking that you're going to make profits in the next year or two, you might decide you just want to carry forward the full 287,000 and not surrender the loss of 138,000, and therefore you would carry forward the full 287,000 losses. But instead you're going to surrender some of the loss, and therefore you would then receive actual physical cash back from HMRC of 20,000. So how does the process work in claiming R&D? So it's done as part of your tax computation and CT600 process, which we do for our clients as part of the year-end accounts. You get 2 years from the end of your accounting period to file an R&D claim. So effectively, you get a year to file your corporation tax return. You then get another year to file an amended corporation tax return. So that's how you got the 2 years. If you think you potentially could have made an R&D claim in the last couple of years, we have had clients come to us and say, can you look back at the last year or two? And then we have made amended claims for them to claim back some cash. For SME claims, HMRC at the moment are processing them within around 30 days. There was a period where it was taking them 2 to 3 months because they had not enough staff to deal with all of the claims, but they seem to have caught up. And normally you get the cash back around a week or so after they have processed the claims. If there is an inquiry on the claim, HMRC, they have 12 months to inquire, but if they do inquire at the point of processing, they can take a few months with the back and forth to get paid out. And there is a specialist HMRC department who deal with the claims and who us at DavisGrant have had a lot of interaction with. So just to finish up, some key questions to consider, and if any of these kind of questions have got you thinking that you potentially could have R&D, please do get in contact with us. So have you developed your own software? Have you developed internal processes to reduce cost or improve production time? Do you carry out any design work that enhances technology? Are you in the business of manufacturing products? Not all manufacturing products will have R&D, but a lot of them do. Have you taken existing technology but improved it or changed it in a bespoke way? Are you combining two or more technologies that have not been done before? So taking two things and combining them together in a certain way. And do you have any pending patents for products or services that could qualify? Thank you. So I'm going to hand back to Stephen to just touch on a couple of the other aspects before we move on to question and answers.
Thanks, Ben. So just wanted to just conclude the talk, just a couple of bits really to do with capital allowances. Often a forgotten tax allowance, but of course, companies, trading companies, if you've got expenses, they are, assuming they're business expenses, they're instantly tax deductible. But if one goes back to a longer time, I say those who are a little bit older on this webinar, of course, if you were to spend money and invest in capital, it would be quite some time before you would actually get the full tax relief from having paid out that amount of money. You'd have certain things called first year allowances that were semi-generous, and now what we've had for a number of years is what's called the annual investment allowance. I think really it came, if I recall, probably it was in the back in 2008, the last recession, and very, very generous. And it was been particularly generous also in this last year. And I'm going to show a slide on it to show actually there's a little pitfall. If you're a business that does invest quite heavily into capital, to do things, really you should be doing them this side of Christmas and not next year. But I'll come on to that on the next slide. But just to remind you, so this is, you're buying an asset, something that's going to last in the business for longer than 1 year. So annual investment allowance, which I'll come on to, and then if it's either you've spent all of your annual investment allowance and you've used that up, you then have a written down allowance, which is not as generous, or if it's something that doesn't qualify for annual investment allowance. So those are 18%. So in other words, you buy something for £10,000, you have £1,800 written off in the first year, and then whatever the residual amount is, 18% of that, and then so on and so forth, each year 18%, 18%, 18%. So you can see it takes a long time for you to get the full benefit of when you have that outlay on capital, as opposed to this annual investment allowance where you get 100% of it written off. So and annual investment allowance is pretty much in the main of all sort of the fixtures, fittings, plant and machinery, computer equipment, that sort of stuff that you may spend. Special rate pool, the 6%. So this is things like integral features in your building. So I don't know, for example, air conditioning, assuming anyone's actually in their offices at the moment, but things like say air conditioning and certain other aspects that are, if you like, integral to it. Quite unlikely you're going to take them with you should you move, but nevertheless they do get an allowance. They're not considered, if you like, part of the fabric of the building and what's called improvements to premises, which wouldn't attract any capital allowances at all. There's also then a single asset pool, which one can elect to put into the pool, so that if you've got a particular asset that you want it to be written down quite quickly for a certain reason, so for example a car or something like that in the business, you may elect just to have it in a purpose single asset pool with HMRC. And the last allowance, it's still there, which is for commercial properties, whether you've converted into a commercial property, there's 3% straight line allowance. So I'll now just touch on the annual investment allowance on the next slide, which is a big pitfall, and it's quite timely just for those businesses. May not apply many of you, but we certainly do have clients in this scenario where the annual investment allowance works in a calendar. It's in a calendar year how it's been done. So from 1st of January to 31st December 2020, the allowance is £1 million. But from 1st of January 2021, the allowance for the year is just £200,000. And yes, in itself, that's obviously quite a significant reduction, but it has a double impact where how HMRC calculate what allowance you get is done, and I've given an example here on the slide, but essentially, if, for example, and many of our clients have them, you have a year end of 31st of March because you want to tie into certain tax year, So the way it works is effectively you get, so say 31st of March, you've got 9 months in 2020 and 3 months in 2021. So how it works is you get 9 months of the million, so you say £800,000, great, and 3 months of the 200,000 of the, so 9 months of the millions, that's £750,000, and 3 months out of 12 of the £200,000, that's £50,000. So that gives you a total of £800,000. So you think, great. The problem is the timing of this. So if you were, for example, to have wanted to spend, for argument's sake, £200,000, and you were deciding, are you going to do it now, this side of the new year, or in January, February? If you were to spend £200,000 in January, only £50,000 of that would be allowable for annual investment allowance. So only £50,000 could instantly be written off your in terms of a deductible expense. That would leave £150,000 that then gets the far less generous 18% written down allowance each year. So the timing of when to invest into capital, and I appreciate that this is, you know, perhaps an unusual time to be talking about investing, but nevertheless, certain businesses, this may be exactly the time that you're considering this, and there may be sizable investments, certain machinery you're thinking of investing in. All I would say is that the timing of this, if you're going to do it and you have certain year ends, really do think about it, and perhaps investing in that this side of the tax year, this side of the calendar year is the way to go. Okay, so that's all the other bits I wanted to talk about. So on to the Q&A.
Thank you both, Stephen and Ben there, very much appreciated. I think on behalf of all the attendees, I'd like to thank you for your time. If anyone is there and has a question for us, please do submit it. I'd like to just ask both of you, I guess Stephen first, is a general question on behalf of everyone, which is, so there was a lot of information there, a lot of worked examples and things that I might have been aware of before or not aware of before. What would you say is the kind of the next step? What's the, if I'm uncertain as to whether I'm making the most out of these allowances across the board, or in the case of Ben, whether I've got an R&D claim, what's my next step?
Thanks, Nick. I'll say, well, if people watching are DavisGrant clients, then of course the next step would be absolutely get in contact with your partner and say you've seen this webinar and certain things have been brought up and you'd like to discuss them further. And if you're not a client of DavisGrant, then feel free to either send an email to our generic info@davisgrant.co.uk email address, or I think this is on the last slide, or find myself and Ben. Our email address is on our website, on DavisGrant's website, or you can find us on LinkedIn and drop us an email or a message there.
Just on the R&D side, again, get in contact with us, or if you do have an accountant, get in contact with them and see if they can help you, or obviously would be more than happy to see if what you do have is R&D.
Yeah, on that then, I guess it feels like there might be people who've got a lot of, it might be dismissing R&D out of hand, saying, well, I'm not I don't really do research, I'm not an academic kind of environment. Do we find that there are a lot of clients who do have a qualifying expenditure that they're not aware of?
Yeah, I think a lot of people have previously thought that R&D was just for, like you said, science projects, or was for software development or building an app, for example. But what we are seeing in the last few years is a lot of industries who have never thought that what they do is R&D, and it actually is. So manufacturing, for example, or construction. These are kind of industries, especially construction, where they previously might not have thought that what they have is R&D, but by doing certain ways or certain projects in a certain way, they can then potentially claim R&D on those costs.
Understood. Thank you very much. Okay, if anyone has any specific questions, please do submit them. We've got a couple here. One for Stephen, which is just one about, I think it's about the inheritance tax allowances. So we said that there is a £3,000 gift allowance for 1 year, so you can gift up to £3,000. The question is, if it's unused, can I carry it forward?
The short answer to that is yes, you can carry it forward just for 1 year and 1 year.
So for 1 year only.
Yeah.
Okay, so if I didn't use it last year, I can do 6,000 this year, but that'll be gone once if it becomes another year.
Yeah.
Okay. Thank you very much for that. And Ben, thank you. We've got a question on R&D from Lindsay, and it seems quite specific, so it might be one that's worth we'll be following up with you, Lindsay. But I will put it to Ben now as well, which is that if you have systems where the suppliers provide tools for self-development and you use these to create work presses for your own specific use, if you have a dedicated member of staff doing this, can you claim for their costs?
If you've taken an off-the-shelf product or service or software, and what you've done is make that software bespoke, and you've got someone internally who's professionally competent and has made that bespoke software which you own, so it's not owned by the software provider, you own that. You could, if you wanted to, sell that to another company or rent it to another company. Then, as long as what you've developed meets certain criteria, then there's definitely potential for R&D there. Yeah.
Okay, thank you very much for that, Ben. That's all the questions we've got. I will be following, as Stephen said. If you do have any questions, if you would like a copy of the slides, please do get in contact. I will be following up with attendees to make sure if there's anything extra that you might need. Or as Stephen said, you can seek out him or Ben. And here is the contact information for our office. So if you have a general inquiry, please do email us at info@davisgrant.co.uk, or you can call the number there. I think there's a missing 0 on the end of the phone number there, so it's 4 zeros at the end. Thank you very much, everyone, for attending. Thank you, Ben and Stephen, for sharing your expertise with us. Hope to see you again soon. Thank you.
Thanks.